Hello everyone, welcome to the Ichimoku.co daily markets review for the trading day ending Tuesday, February 23rd. Just taking a look at the performance today, and the worst performer in the equities markets was the Nasdaq 100. It was down 1.62%, followed by the S&P, which was down 1.25%, and the Dow was down 1.14%. And the better performer, even though down, was the Russell 2000, the broader index, and the smaller cap stocks down 0.94%. Over here to the right hand side, gold saw some buying today, perhaps a flight to a safe haven may be beginning again. It was up 1.5%, and the bonds was up just 0.4%. We're using the ETF, the 20 plus year Treasury Bond Fund, as our proxy for bonds here, and certainly doesn't look like we've seen a strong flow of capital into the bonds away from equities, but there has been some flow. Looking at the VIX here, VIX was up very strongly, the VIX indicator, suggesting that there is some doubt about the market at the moment, some fear growing, and that's natural with the market being down around roughly on average down around 1% in the equities markets. Firstly, looking at the S&P 500 on the Ichimoku chart, and we see a very clear change of trend in the first term time frame today. Today's candle making a lower high and a lower low. Formation of a black body candle suggests that the sellers have taken control away from the buyers who had control for the previous day's trading. The buyers did very well to close up through the 1925 level of resistance and that small highlighted yellow zone of previous resistance. And today, though, that strong buying has been negated, as I've said, with the sellers taking control. We also saw a window open on that previous day's trading, and the market has almost closed that window, but not quite, and that may continue to hold as support. So it trades down to about 1915, and also it's within that highlighted yellow zone, and that zone could hold as support. The bottom of it down around around the 1916 region as well. If the market does trade down through there, if we do see strong follow through when we do close down through there, looking to support to come in around the round number 1900, and with another window that was opened down below there, it does suggest that it may offer very strong support. Looking at this previous rally that we saw the market in, and we saw three gaps develop as the market was trending up, and this suggests that there was quite a lot of enthusiasm in the S&P over the last week or so, and it is just giving us a bit of a hint that if we do see some buying come back into the market, we could see the selling that we've got now from today's candle exhaust. And I'm expecting that if we do trade down through this region, this 1900 area is going to be very important. Now, even if we do see the market bounce off one of these levels and continue to trade up, we will be running into some important cloud resistance over the next couple of days, and it actually moves lower, and after the next 2 or 3 days it becomes quite thick. So if we are going to see this market change the trend in that longer term time frame by trading through the cloud, the buyers will have to be quite strong over the next day or two, and that's their best opportunity to change that trend. As we move further into the next couple of weeks, the cloud is very, very thick, and they will need to be even stronger to change the trend in that longer term time frame. Now, in the medium and fast term time frames, we do have a bullish market. We're trading above each of the Kijun Sen and the Tenkan Sen, but looking at the Chikou span, that's within the corresponding price action, so it's failing to support the bullish activity that we're seeing in those shorter term time frames, and suggesting that we could see the market just continue to come off. But with the sellers in control today, there is an opportunity here for selling to continue at least over the next day. Now, just looking to the bands here with the S&P, and there was an opportunity here for the S&P to transition into a strong bull phase, some strong bullish sentiment, but we've seen a lack of follow through every time that we've broken out to the upside above the upper band. And what we want to see is the breakout, but we want to see strong follow through. So here you have a very strong bullish breakout, and then the market come off with the sellers coming back into the market for the day prior to today, breaking out again, and then the sellers coming back into the market. But the fact that we are now trading above the upper band on a couple of occasions does suggest that that very strong negative bias that we saw in the market previously, that strong negative sentiment, may have terminated, and if we are going to see the market break out to the upside again and then some strong follow through, and I suggest that we want to see the market trade through this previous swing high where we found resistance for the prior day's trading as well around 1947. If we can trade up through there in a bullish manner, we could see the trend develop further to the upside. If this first time frame downtrend does continue to the downside, watch the middle of the bands at 1897 to hold a strong support. Just moving to our market breadth indicators, and this is the advanced decline line, the cumulative advanced decline line, and we are still trading down below that 50-day moving average, and that tends to be a good benchmark, and we traded just 2 there for the prior day's trading, and the market is backing off from there. So what we want to see is the market sustaining, or sorry, the advanced decline line sustaining above that 50-day moving average and then up through that upper band, and that would suggest that we could see a decent rally. But at the moment, with it coming off here, there is an opportunity here for continued selling in the S&P, that is. Looking to the HighLow Index, and this is just a 5-day HighLow Index, and we have been in an overbought area for the last couple of days, and we can see in a cyclical manner the market moves into these areas and then comes off, or the HighLow Index moves into these overbought positions and then comes off, and we then tend to see a very short-term time frame downtrend, and that's what we're seeing here at the moment. The HighLow Index has turned down, but I suggest that we should wait until we move down through the 70 level, down back through the overbought area, if we are going to see a confirmation of that new first time frame downtrend. And looking to the VIX indicator, and the VIX has been trending lower for the last 4 or 5 trading days and down outside of that lower band, but just for today we've seen it start to tick up. So with the market selling off, the sellers in control, we are perhaps seeing the market participants starting to become a little bit scared of another first time frame downtrend. But still, until we move up through that moving average, we're not going to have any strong confirmation of that. Looking at the VIX oscillator, we have been trading down below that minus 5% level, which means that the market participants are feeling quite safe and now moving back into there, so into a neutral zone. And if we do move above that 5% area, plus 5%, it may suggest that we could see some strength in this sell-off to the downside. Moving to the high yield bond spread and looking at the difference between the yields here, and the spread for the yields between corporate bonds and government bonds has been decreasing as the market's been trending up quite strongly. We are still below the moving average here, and we have just seen that tick up, and if we do move above that moving average and then certainly above that upper band, then we could see the market continue to come off. But at the moment, just a hint here that we could see development of a continuation of the downtrend, but still not convinced about that because we are beyond, just below the moving average. Next, looking at some market sentiment indicators and the moving averages here, looking at the percentage of stocks in the S&P 500 that are above or below their various moving averages, and the short-term moving average is the 5-day, and we've seen a cyclical peak form in the percentage of stocks above their 50-day moving averages, and it's moved just down below the 50% level, and suggesting that we certainly could see continued downside, and we may have seen a high form in the market here in the very short-term time frame. The percentage of stocks above their 20-day moving average has moved down slightly. It is at a fairly high level. It is at 73% at the moment, and it has come off, and this suggests that we could see further downside as well. The percentage of stocks above the 50-day moving average has moved back down below the 50% level at 47%, and the percentage of stocks above their 200-day moving average remains fairly low and is at 31% at the moment. So on a long-term basis, we aren't seeing a lot of strength in this market in terms of that sentiment. To our Ichimoku breadth market sentiment indicators, and firstly on the top chart, the top subchart, we examine the percentage of stocks that are above the Tenkan Sen in the percentage of stocks in the S&P 500 that are above the Tenkan Sen, and it is at a very high level, so at something of an extreme, still at 89%, even though it has moved down, and this suggests that the market is still bullish, but we may have seen a peak form here, and we could see some selling come into the market in the short-term time frame. Next is the percentage of stocks above the Kijun Sen, representing that medium-term time frame. The percentage of stocks in a medium-term uptrend is at 75%. An extreme level, and has moved lower, and suggesting we could see the S&P come off. And the percentage of stocks above the Ichimoku cloud is at 47%, and has moved just back down below that 50% level. And the percentage of stocks below the cloud suggests that we're at 17%, a fairly low level, and suggesting that we don't have any strong indication of a new bear market developing yet. But we certainly could see a short-term pullback based on the percentage of stocks above the Tenkan Sen being quite high at 89%, and the percentage of stocks above the Kijun Sen remaining high at 75%. But both of those indicators have been coming off, suggesting that sentiment may be starting to turn just slightly negative. Just looking at our asset class ETFs and comparing them on a relative strength basis to the S&P 500, and firstly with TLT, the ETF representing 20 plus year Treasury bond fund, and we've seen support coming in at the Kijun Sen, the buyers coming in quite strongly today, as we saw earlier. The buyers are closing with control, but a couple of days ago the Tenkan Sen was holding as resistance, so 131.98 is an area we should be watching, and if we see the market back off from there, once again there is a possibility of or a suggestion that we could see the market start to transition into a new downtrend phase, but that really depends on whether we can close in a bearish manner down below the Kijun Sen indicator, which trades at 129.89. In terms of relative strength on that chart, has been trending down quite strongly over the last week or two, and continues to move lower, but is above the 100% level, so relative strength is strong, but is pulling back, and momentum of relative strength we can see here is below 100%, so it is suggesting that TLT on the daily charts compared to the S&P 500 is weakening relative to the S&P. Also comparing the gold ETF, and here we've seen it move back up above the Tenkan Sen indicator, so a bullish market in all three time frames, and also the band chart here remains quite strong, moving back up above that upper band, highlighting a very strong bullish bias. But in terms of relative strength, up above the 100% level, so outperforming the overall market on a medium-term basis, but it has been pulling back and is now below that lower band. And looking at momentum here, it is below 100% and has been moving lower. So still we are seeing gold on a relative performance basis against the equities markets represented by the S&P 500. It is